All right. So now we are going to talk about contract cost, and then after that we will also talk about service concession arrangement, right? So essentially, when we look at revenue recognition, Ind AS 115s, right? So we've talked about at length different elements is what you need to look at from a standard perspective. So Ind AS 115 looks at 5 elements, which is to say that identify the contract with the customer, determine your performance obligation, determine the contract consideration, allocate the performance obligation, allocate the contract consideration to each of the performance obligation, and record revenue as you fulfill your performance obligation, right? And we discussed at length, right, the different nuances in each of these steps with different examples, with examples which have also come during the course of the exam. So I hope it's been able to, in a way, you've been able to make sense out of what all we've covered so far. Now, Ind AS 115, in a way, also introduced a new concept, which is to allow contract cost to also be capitalized, right? And what is the meaning of the contract cost here, right? When you look at contract cost here we are talking about two types of cost, okay? Contract cost, which you incur in relation to acquisition of a contract, and cost which you incur in relation to fulfillment of a contract. Okay, two types of cost. One in relation to actual, let's say you're signing a new contract now with a customer, right? And these are all again in the context of material cost, right? So you are signing a contract with a customer, as a result of which you incur incremental cost of, let's say, hiring a third party, getting some diligence done, this and that. You may have to pay some upfront contract acquisition cost to a customer, to the third party, or let's say you pay a deal bonus to anybody. So all of that, in a way, there's no revenue, right? As you have just signed up the contract, there's no revenue. Revenue will come over a period of time. So the cost which you incurred in relation to acquisition of a contract, and if they are incremental, not your salary cost, okay, but if, let's say, you're entitled for a bonus which is linked to a successful consummation of this contract, then that possibly that bonus, right, which otherwise you're not entitled for, that means it becomes an incremental cost, okay? And incremental cost which is related to this signing of the contract, okay, like a contract acquisition cost, okay? So if I have a contract acquisition cost which I have incurred, which is incremental, and I can demonstrate the contract which I have acquired or signed up is profitable and I will be able to recover this cost, then you are allowed to capitalize the contract acquisition cost as a separate asset in the balance sheet, and amortize that over the life of that estimated life of that contract. This is outside the purview of Ind AS 38, so to say, intangible asset, or Ind AS 16 on property, plant and equipment. So you're allowed to capitalize a cost which otherwise is not allowed to be capitalized. Okay, so that's an important in a way a concept which has been introduced through Ind AS 115. That's one. The second is the fulfillment of a contract. So let's say you've entered into this contract, you started incurring certain costs now, but there's no revenue, because revenue you can only start recording, as we just discussed, when there is a transfer of control. And transfer of control can happen over time or at a point in time. So now let's assume that you started incurring cost and there is no transfer of control. That means there's no revenue, but there is a cost. So again, the standard permits you to capitalize those costs as well, in the intermediate period, to be amortized over the contract period, right? So we will try and understand both these nuances in a little bit of more detail. So incremental cost of obtaining a contract are capitalized if they are expected to be recovered. Incremental costs are costs that would not have been incurred if the contract had not been obtained. Okay, not been incurred if the contract had not been obtained. practical expedient to allow immediate expense recognition if the amortization period of the asset would be 1 year or less. In a way, it says you don't need to capitalize this if you anyway believe that the benefit period is not going to last for more than a year, right? So in other words, this is also not an accounting policy choice. So you have to do it. You have to capitalize, right? If there is an incremental cost of obtaining the contract in and amounts are material in a way from that perspective. Now, so that's what cost of obtaining a contract, and then there's a second element of cost of fulfilling a contract, right? That are not addressed by another standard are capitalized if they relate directly to a contract or to specifically a anticipated contract, generate or enhance resources that will be used to satisfy performance obligation in the future. That means you have yet not fulfilled the performance obligation, but you started incurring the cost, right? Cost of fulfilling a contract are expected to be recovered. If you believe they are expected to be recovered, then you are allowed to capitalize them, and amortized over the period the goods or services are transferred and are subject to impairment review under Ind AS 36. And impairment review under Ind AS 36 is follows: higher of the two, right? Value, recoverable amount, right? Value in use or fair value less cost to sell, whatever is higher of the two. So essentially here you will end up dealing with value in use. There's nobody's going to buy this, right, from you. So that's how you deal with contract cost. Remember, two types of contract cost we're talking here: cost of obtaining the contract and cost of fulfilling the contract. Let's take an example. The information technology data center of customer Z is outsourced to entity A. The details of the contracts are as follows. Term is 3 years plus 2-year renewal option. Okay, 3-year plus 2-year renewal option. Average customer relationship 2-year, right? Plus 2-year renewal option. Average customer relationship in this case is 7 years. Now, for designing and building the technology platform required to accommodate this outsourcing cost contract, customer A has spent INR 6 lakh rupees. The breakup of the expenses as follows: design services, hardware, software, migration and testing of data center. In total, I've spent how much? 6 lakh rupees, right? Now the question is, I need to determine how much such cost be treated, how you need to do accounting of these costs by entity A, okay? So you look at hardware, that I can capitalize under Ind AS 16, right? Software, I can capitalize that under Ind AS 38. But migration and testing and for design services, these two costs are not allowed to be capitalized either under Ind AS 16 or under Ind AS 38, right? And that is where you look at Ind AS 115 as a contract fulfillment cost, okay? So let's look at the solution, okay? Now, design services resulting would be amortized over 7 years. This is under Ind AS 16, this is under Ind AS 38, this is under, Ind AS 115 to be amortized over 7 years. So that's how you look at capitalization of cost which is incurred in relation to fulfillment of a contract for which you're yet to start recording revenue, right? All right. So let's look at another example, of in relation to amortization and impairment. So Hardwork Limited enters into a contract with a customer. The contract is a service contract for which the company has incurred incremental cost to obtain the contract, okay, and cost to fulfill the contract. In accordance with Ind AS 115, these costs are capitalized as assets, available information. Now, initial term of the contract is 4 years, but it can be renewed for subsequent 1-year period up to a maximum of 10 years. The average contract term for similar contracts entered into by Hardwork Limited is 6 years, okay? So we have multiple information. I have contract cost, which is eligible. Then I have initial term, 4 years. Then I have renewal option, 1 year. to, let's say essentially I have 6 options. Total term, including these options, is 10 years, and likely expected term is 6 years, right? All the information is given here, right? Now you are required to determine the appropriate method of amortization. So essentially, I'm going to look at this cost being capitalized. What's the useful life? The useful life is 6 years. I'm going to amortize it over a period of 6 years. That's the period over which Hardwork Limited expects to provide services under the contract to which the capitalized cost relate. 6 years. 4 year plus 2 anticipated 1 year renewals, because that's the information which is what is being provided. And you need to also test it for impairment on if there are indicators for impairment. Awesome. So that is what was about the contract cost. So contract cost in relation to obtaining a contract or fulfillment of a contract is what you need to consider. Now we're going to talk about service concession arrangement. Okay. Now, what's a service concession arrangement? Let's just kind of quickly try and understand this whole concept of service concession arrangement. It is essentially when it is actually in the context of a public-private partnership. Okay, public-private partnership. All right. So what are we trying to say here? The government needs to get a projects done. Okay. Now, government don't have enough money for all of these projects, right? So they want to invite private sector to participate in infrastructure building. Okay. So that is what is called public-private partnership. Okay. Private sector comes to the rescue or comes to participate in the projects as required by government in any jurisdiction. Okay. So both parties are coming together to build infrastructure assets. Now, what are infrastructure assets? Like roads, like toll roads, right? Like bridges, like tunnels, right? Like hospitals, right? Like airports, right? Like ports, right? So all large infrastructure, like power plants, right? All large infrastructure assets which require enormous amount of capital, and hence both parties come together to build the assets, right? Okay, up till now this is good. So both parties have come together to build the asset. That is what is called public-private partnership, and then they get accounted under service concession arrangement. Okay. Now, why do they get accounted under service concession arrangement? Because the asset is not owned by the private operator. Okay. The private operator is only operating the asset. The private operator is using the asset to provide a service, okay, as directed by the government. Okay, as directed by the government. Essentially, the asset is controlled by the government but operated by the private operator, right? If I am the owner of the asset and the private operator owner of the asset, then there is no public-private partnership here, right? Because assets are supposed to go back to the government, right? Of any jurisdiction, as the case may be. So now, so we have a public-private partnership arrangement. Why is this being called? Because the asset is eventually being owned, and also the usage of the asset is also directed by the government. It is operated by the private operator. Okay. Then the third element comes is that who is going to pay for it, right? Who is going to pay for it, right? So, and there are two types of model, right? In one model where the government is going to pay for it, okay? Government says, look, build this toll plaza or build this road, 100-kilometer road, and I'm going to pay you every year 100 crores for next 20 years as a cost of recovery of your investment in that road. Okay, and this is what purpose you need to let the users use it for, in a way. Or build this hospital, and I'm going to pay take all the expenses and cost, and this is what I'm going to pay you over next 20 years. So that is what is called a financial asset model. In a way, government is responsible to make the payment in relation to that asset to the private operator. Okay, that's one type of revenue arrangement. The other type of arrangement, government says, look, I am not going to pay anything. I have nothing actually. Okay, what do I have? I have, of course, I'm the government, right? So I have the right to build this asset, and then I'm allowing you, the Mr. Private Operator, to charge the users, okay, to charge the users. And that's what the toll plazas are, right? When you cross a toll plaza, you have to pay, right? And when you have to pay, the money actually goes to the private operator, right? Because that private operator has invested in building that infrastructure based on the rights that he has purchased from the government of any jurisdiction, right? So now that's another way of financing the cost of building that infrastructure. So either government will pay or the public will pay, right? So if the government will pay, then I, as the private operator, I know how much I'm going to receive, right? And that is where it becomes a financial asset receivable in my books. If the government says, I'm not going to pay, you got to collect it from the user, then it is like an intangible asset which I have, and I need to mine that intangible asset by making sure there's enough traffic on the infrastructure I have, and I collect toll from each of the individual users. Or there could be a hybrid model as well. There could be a hybrid model as well, where government may pay something and I also have a right to collect the toll from the user, though at a subsidized rate from that perspective. So that's what is all about service concession arrangement. Okay, a service concession arrangement means what? There is a government and there is a private operator. Both of them come together. Why? To build the infrastructure. Now that, why this accounted here? Because that infrastructure is continues to be owned by the government, is operated by the private operator, and the payment of that is guaranteed either by the government or allowed by the government to charge to the users a usage fee for the use of such asset, right? So that is what is all about service concession arrangement. Let's go through that in fair degree of detail with the help of an example. So service concession arrangements involves a private sector entity constructing the infrastructure used to provide the public service or upgrading it. For example, increasing the capacity and operating and maintaining that infrastructure for a specified period of time, maybe for 10 years, 20 years, 30 years, 40 years, 50 years. They are for a long period of time. Ordinarily, we see like 20 years, right? Minimum is 20 years. What we see, 20 years to 50 years is what ordinarily. Let's say recently there were a lot of these airports auctions which happen, right? They're all for 50 years in a way from that perspective. Most of the toll plazas we see, they're for 20 years, rights which are given to the operator by the government. The operator is paid for its services over the period of the arrangement. The arrangement is governed by a contract that sets out the performance standard, mechanism for adjusting prices, and arrangement for, of course, arbitration dispute. And we have disputes like crazy. But anyway, that's not the thing we are trying to learn here. Now, such an arrangement is often described as build, operate, transfer, right? BOT, okay? BOT, build, operate, transfer, right? It also build, own, operate, and transfer, boot model. There are multiple names for it, right? So build, own, operate, transfer, build, operate, transfer. So essentially you build the asset, you operate the asset, and eventually the asset gets transferred to the government, right? Under that contractual terms, and the payment for this could also come from the government or maybe coming from the user of the asset, from that perspective, to be done in a public to private arrangement, public to private service concession arrangement. An example is infrastructure for public services such as roads, bridges, tunnels, prisons, hospitals, airports, water distribution facilities, Energy supply and telecom networks has traditionally been constructed, operated, and maintained by the public sector and financed through public budget appropriations. So what are the number of things you need to look at, right? Treatment of operator right over the infrastructure. So I as an operator, if I have that right, how do I do the accounting of that? How do I deal with the recognition and measurement, right? Recognition and measurement, okay? Contractual consideration given by the grantor to the operator, consideration given by the grantor to the operator, and grantor is the government, right? Grantor is the government, right? And then the contractual obligation to restore the infrastructure to a specified level of serviceability. There could be, making sure that the asset perform at certain level or maintained in those conditions, right? There could be a borrowing cost incurred by the operator. So then, and when, whether it's a financial asset or it's an intangible asset, right? And then items which are provided to the operator by the grantor, right? The number of things which you need to look at while you're looking at accounting for such public-private partnership or service concession arrangements. So now we're going to look at the treatment of the operator rights over the infrastructure, right? So essentially, from an operator perspective, I don't own the asset. So that is why you're not allowed to record that as a fixed asset, right? What do you own? Actually, you have a right to charge, right to use, right? From that perspective, or right to charge the users for the usage of the asset. So your right to operate the asset, and that is why it is recorded as an intangible asset, right? So infrastructure shall not be recognized as property, plant, and equipment of the operator because the contractual service arrangement does not convey the right to control the use of the public service infrastructure to the operator. You only have the right to operate. In a way, when I say control, means, let's say I don't want anybody to access this road. You don't have that right as the operator. Anybody and everybody who has the ability to pay the toll charges as fixed by the government, has the right to use the road, right? Or has the right to fly, has the right to use the airport, has the right to use the port. So these are public infrastructure assets. These are not private property, right? So if there's a public infrastructure assets, that means I am not the owner. So I cannot direct the use. I can only operate the asset as directed by the grantor, and grantor is the government, right? The operator has access to operate the infrastructure to provide the public service on behalf of the grantor in accordance with the terms specified in the contract. So it is not a property, plant, and equipment, but it is recorded as an intangible asset, or at times it is not even an intangible asset, because essentially, I'm just operating it for somebody who's already paying me for it. So it's a financial asset for me. Okay. And that's where there are two revenue models here, right? So recognition and measurement. Since the operator acts as a service provider, he shall recognize and measure revenue in accordance with Ind AS 115. So essentially what happens, that when you're providing the construction services, you are supposed to record the revenue. So essentially you're doing two things. You're providing the construction services while doing the construction, and then you're operating the assets, right? There are two types of services in a way being provided. So since the operator acts as a service provider, recognize and measure revenue in accordance with Ind AS 115 for the services it performs. You are constructing or upgrading infrastructure used to provide a public service and operate and maintain that infrastructure. Operation services, two types of, right? Construction and operation. If an operator performs more than one service, which is construction, upgrade, and operation under a single contract or arrangement, consideration received or receivable shall be allocated by reference to the relative fair value of the services delivered, right? Now, whether it's a financial asset or intangible asset needs to be determined. When it is a financial asset, when government has guaranteed, look, this is what I am going to pay, right? Then it's a financial asset. That means I have a receivable from the government of India or government of any other jurisdiction. When the government has not guaranteed, government has only allowed me to use the asset or operate the asset and charge the users based on predefined formula, then it's an intangible asset model for me. All right. The operator shall account for revenue and cost relating to construction or upgrade services. The operator shall account for revenue and cost relating to operation services also in accordance with Ind AS 115. Now, in the case of consideration given by the grantor to the operator. So, consideration, if the grantor is making payment to the operator, revenue shall be the consideration received or receivable shall the operator be recognized at its fair value, right? The consideration may be rights to a financial asset, I'll make you the payment, or an intangible asset that I'm allowing you to charge the users, right? The operator shall recognize a financial asset, okay, a receivable, to the extent that it has an unconditional contractual right to receive cash or another financial asset from or at the direction of the grantor for the construction services. The grantor has little, if any, discretion. Grantor has little, if any, discretion to avoid the. That means the government is saying that, look, I'm going to make this much payment to you over next 20 years, right? For you to build the infrastructure and maintain the infrastructure and let public to use the infrastructure, right? Similarly, I as an operator, I have an unconditional right to receive cash if the grantor contractually guaranteed to pay the operator specified or determinable amounts, the shortfall, if any, between amount received from the user of the public service and specified or determinable amounts, even if the payment is contingent on the operator ensuring that the infrastructure meets specified quality or efficiency requirement. All right. So whether you follow a financial asset model or an intangible asset model, it depends upon how much is the commitment made by the grantor. Okay. Consideration given by the grantor to the operator in relation to operating and using the asset and then charging the public, you will record an intangible asset. To the extent that it receives a right to charge the users of the public service. If I don't have a right to charge, then I don't have an intangible asset. But if I have a right to charge, then it is an intangible asset for me. If the operator is paid for the construction services partly by a financial asset and partly like a hybrid model, intangible asset, it is necessary to account separately for each component of the operator consideration, right? It's accounting slightly become a little more complex. Contractual obligation to restore. So if like, as you have in India 16, like an asset retirement obligations. Okay. Here also, if you have an obligation, you got to assess that obligation under India 37 and accrue for those costs and deal with that in your impairment assessment. If you have an intangible asset or your profitability in the context of a financial asset model. Awesome. So the operator may have contractual obligation. It must fulfill as a condition of its license, like to maintain or restore infrastructure, except for any upgrade element, which shall be recognized and measured in accordance with Ind AS 37, right? That is at the best estimate of the expenditure that would be required to settle the present obligation at the end of the reporting period. Now, if you have incurred borrowing cost, right? If the borrowing cost is incurred by the operator, you got to record this as an expense in which they are incurred unless I'm recording an intangible asset. And if you're recording an intangible asset, then of course you're allowed to capitalize the same under Ind AS 23 model. But if it is not an intangible asset, then it gets subsumed as part of your financial asset model and gets expensed as you're doing the construction services. Yeah, if I does not have a right to receive an intangible asset, right, attributable arrangements shall be during the construction phase of the arrangement and gets then in a way recorded as a financial asset. So you go for financial asset, right? You're going to apply Ind AS 32, Ind AS 107, and Ind AS 109. All of this you need to look at, and whatever the amount which is receivable, they need to be accounted at the amortized cost, fair value through other comprehensive income, or fair value through profit or loss by looking at the terms and conditions of that right, what you have, right? And if it is measured at amortized cost or fair value through other comprehensive income, Ind AS 109 in a way requires interest calculated using the effective interest method. See, we're not going into a lot of detail or examples because historically this topic has not been tested, right? But of course, there's a lot of detail out there. We've seen few applications of this in all of these infrastructure projects and interesting accounting, right? And though we have an example which we will take you through as well. For recognition and measurement of intangible asset, one has to apply Ind AS 38. Like for financial asset, you apply Ind AS 32, 109, and 107. Here you will apply Ind AS 38 for recording and measurement and then subsequent accounting as well. So what all goes as part of intangible to which the operator is given access by the grantor for the purpose of the service arrangement are not recognized as property, plant, and equipment. They're recognized as intangible asset because why it's not my PPE is because I am not the owner. I'm not in control. I only have right to operate the asset. The grantor may also provide other item to the operator that the operator can keep or deal with as it wishes. If such asset form part of the consideration paid by the grantor, they are not government grants as defined in Ind AS 20. They are recognized as asset of the operator, measured at fair value on initial recognition, and the operator shall recognize a liability if I have to pay something in relation to those assets. Then disclosures, disclose, and disclose. A number of disclosures, so description of the arrangement, significant terms of the arrangement that may affect the amount, timing, and certainty of the future, from where the money will come, we got to disclose that. The nature and extent, right, of the right to use the specific, like it's about 20 years, 30 years, 40 years. What are my obligations, right? What are my obligations to acquire or build item of, are there other obligations? I need to expand the road. I need to do this. I need to do that. All of that, right? Obligation to deliver rights or rights to deliver or rights to receive specified asset or, renewal and termination options, other rights and obligations, the changes in arrangement, all of that is what I need to disclose. How the service arrangement has been classified like a financial asset or intangible asset, I need to disclose that as well. Okay. More disclosures. Disclose the amount of revenue and profits or losses recognized in the period on exchanging the construction services for a financial asset or intangible asset in a way when I'm doing the construction, how much profit I've recorded during the construction, which is resulting to recognition of financial asset or an intangible asset. And then disclosures as required as per para 6 of the appendix shall also be provided individually for each service concession arrangement or in aggregate for each class of service concession arrangement. Now you can group them together as well for similar types of service concession arrangement in a way from that perspective. So lots of disclosure as usual, right? So let's try and look at this example. Okay, Highway Limited is engaged in the business of infrastructure development. The company has two divisions: toll roads and wind power. Two types of things I'm doing. The details of these businesses and underlying projects are as follows. The Indore and Patna toll project, the construction of the project commenced in the current year, and total expenses incurred aggregates to INR 100 crore on 31st of March 2020. Under IGAP, it has recorded such expenses as intangible asset in the books of account. The details of the concession arrangements are as follows. Estimate of total expenses on the project is 200 crores. The fair value of the construction services is 220 crores. The cash flow guaranteed by the government under the concession agreement is 400 crores. Finance revenue over the period of operation phase, which I've already received, is 30 crore. Now, other income relates to the services provided during the operations phase. Now, there's more information. The Solapur-Pune Expressway, right? The company has also entered into another concession agreement with Government of Maharashtra in the current year. The construction cost for that project is 220 crore. The fair value of the construction services is 400 crores. As part of the concession agreement, the project is a toll based and the company needs to collect the toll from the users of the expressway. Here the government is not committing anything. Under IGAP, Highway Limited has recorded the expenses incurred on the project as an intangible asset. You are required to determine the classification of Indore-Patna toll project as per applicable Ind AS, provide brief reasoning, the classification of the Solapur-Pune Expressway toll project as per applicable Ind AS, provide the brief reasoning, also suggest suitable accounting treatment for preparation of financial statement as per Ind AS for those two projects. All right. Now, so essentially there are two types of project we are doing. One, I'm doing the construction and the government is committing. The other one, I'm doing the construction but the government is not committing and I'm giving me a right in a way to collect the toll from the user of the expressway. So how do I deal with this? For the Indore-Patna toll project, the operator has a contractual right to receive cash from the grantor. The grantor has little, if any, discretion to avoid the payment. Hence, operator recognizes a financial asset to the extent it has a contractual right to receive cash. In the Solapur and the Pune Expressway, the grantor is not giving anything. Here, I have a contractual right to charge users of the public services. So, I'm going to record an intangible asset to be used for duration of the project, right? And I have and there is right to charge user public is not an unconditional right to receive cash because it may so no public is using it, right? That's possible. Because the amounts are contingent on the extent that the public uses the service. Therefore, the operator shall recognize an intangible asset. Okay, that's step one done, right? One is financial asset, the other one is an intangible asset. Now we will see how you record them, right? So I'm going to record first, I'm going to do it for the Indore-Patna project, right? I'm going to record a financial asset. How much? 220, which is the fair value, right, of the construction services. And then I'm going to record a revenue, right? I'm providing construction services. That's my revenue. I'm going to incur cost. How much was my cost? 200. I'm going to record the cost of construction and credit cash in a way. So in my P&L in this period, my revenue is 220. My cost is 200. I make a profit of 20, right? That's my P&L of this project, right? And then I'm going to record a financial asset of how much? I'm recording a financial asset of 220, right? And then I've received, of course, the other income of how much? 30, right? I'm going to record this 30 as my revenue as well. So my financial revenue or financial asset also comes to 30. Because the government is going to pay me how much? 400, right? So now the 400 minus 220 minus 30 is 150 is the future financial asset, which I will be receiving over a period of time, and I'm going to record that also as revenue. This money is anyway coming like a interest income. Okay, the form and nature in which it is coming is like an interest income. Okay, 150, right? And then I'm going to receive this cash, 400 rupees or 400 crores, whatever that number is, credit my financial asset. That's the accounting for the Indore Patna toll project. Now I'm going to do accounting for the Solapur project. Okay, how do I deal with this? Here government is not giving me anything, right? But still I am providing the construction service to the government, and in exchange I'm getting a right to operate the asset, an intangible asset. How much is the fair value of the construction services? 400, right? So I'm incurring a cost of construction 220 and bank going out 220. And then there is an intangible asset 400, and then construction revenue. So my revenue here is 400, my cost is 220. So in my year one during the construction, I record a profit of 180, right? I record up, which is very, very high, 180 profit, but that's the information provided in the question. So you're going to record a profit of 180, 400 as an intangible construction revenue, and the credit of this, in a way, the debit of that goes into intangible asset. Okay, and now I'm going to look at the future. Okay, I'm going to amortize this in the future period. Amortization expense to intangible asset, done and dusted over the period over which I have a right. So let's say 20 years. So these entries are going to pass over 20 years, right? And then I'm going to record, cash, which I'm going to receive, and then credit revenue. Now this information is not available, so I just parked an entry with no amounts, right? In this example, the amount in the last entry is kept blank, as no information is this given in this question that how much you're collecting, right? Eventually over a 20-year period, or over the period of the right, you have to operate the asset. Awesome. So let's quickly summarize what we've talked about. There are three parties: the grantor, the operator, and a general public. The operator is responsible for operation and management. The contract sets the prices. Operator is obliged to hand over the infrastructure. The grantor decides what services to be provided, to whom the services to be provided, at what price it must be provided. An operator does not recognize infrastructure as property, plant, and equipment. It may recognize it as a financial asset or as an intangible asset, depending upon how the operator is getting compensated, how the cash is coming in. If the cash is guaranteed by the grantor, then that comes as a financial asset. If the cash is not guaranteed by the grantor, but comes by way of service charges from the user, then that is an intangible asset, right? And then, of course, there are tons of disclosures which you need to make. Okay. So now we look at the overall presentation and disclosure under Ind AS 115, and disclose, and disclose. A contract liability, I need to disclose. Contract asset, I need to disclose. Receivable, I need to disclose. Liability is presented in the balance sheet depending upon the relationship between the entity. Performance are subject to impairment review in accordance with Ind AS 109, because these are financial assets, right? An entity shall present separately the amount of excise duty included in the revenue. All of that you need to present. Excise duty is now been replaced by GST. So, but in some jurisdiction, you may still have it. You never know. And then you got to look at the contract balance, the cost to obtain or fulfill a contract, the disaggregation of revenues, the performance obligations, the significant judgment, the contracts with customer, performance. So all of that, all of this, is what you need to look at from a disclosure perspective in the financial statement. Fantastic disclosures, a lot of information. So now when you look at the differences between Indian GAAP and Ind AS, number of differences which is out here. Framework, of course, here when you look at a framework of revenue recognition within a standard, right? Whereas AS7, AS9 in a way looks at, you've got to record revenue when there is a transfer of risk and reward, right? And the collectability is reasonably assured. Here it is, much more broader, a lot more detailed guidance. And then it talks about the multiple element arrangement, which is not covered adequately in AS7 and AS9. Number of other areas, right? It comprehensively deal with all type of performance obligation, but it does not talk about interest and dividend, right? Because they're covered under financial instrument, whereas in the AS9 in a way talks about interest and dividend, royalties, and all of that as well. The measurement guidance, again, it is a lot more driven by fair value, standalone, relative standalone. There's lots of guidance, whereas it is largely driven by the terms of the contract with the customer, right, as per AS9. So again, a fundamental difference between. So I would say Ind AS 115 is a lot more substance driven accounting standard, whereas AS7 or AS9 is a lot more form driven, from a revenue recognition perspective. More differences. Recognition of revenue in AS 115, revenue is recognized when the control is transferred, right? Whereas AS now, in AS7, AS9, so this whole notion of control itself has not been addressed with that degree of detail, right? So when you record revenue and significant risk and rewards of ownership is transferred to the buyer, in a way. So again, very different answers you may end up in different situations. Capitalization, Ind AS 115 provides for contract cost or obtained cost or to fulfill cost to be capitalized, not allowed under AS9. Or do not deal with such capitalization. Service concession, detailed guidance, we talked about that under Ind AS 115. In the accounting standard do not provide such guidance. Tons and tons of disclosures under Ind AS 115 as compared to AS7 and AS9. And then we've got bunch of questions, which I'm going to let my colleague Amit to talk you through, discuss all of that. Thank you very much.